Rates are high, activity is slow, and the headlines are loud. But for serious real estate investors in Ontario, this is exactly when smart financing matters the most. The decision between fixed and variable rates right now just isn't all about interest. It's about cash flow, control, and how fast you can move with the right opportunity hits. So let's talk strategy. Hey, I'm Yasin, a licensed mortgage agent in Ontario and a real estate investor with over 15 years of hands-on experience. So I get it, the market feels uncertain right now. Buyers are cautious, investors are waiting, and many are unsure whether to act or hold tight. But here's what I know, uncertainty is where strategy gives you the edge. This is when smart investors are restructuring their debt, setting up lines of credit, and positioning themselves to scale as conditions shift. And that's what this channel, Mortgages by Sal, is all about. It's about helping Ontario real estate investors make confident, strategic financing decisions no matter what the market's doing. So if you want clarity instead of noise, then subscribe. And if you're planning to buy, refinance, or just want to prepare, use the link below to book a strategy call or get pre-approved. So let's break down the core differences, but through the lens of an investor. So a fixed rate mortgage gives you a stable, predictable payment over the full term, typically 1 to 5 years. This can be great for long-term holds or conservative cash flow models. A variable rate mortgage, on the other hand, fluctuates based on the Bank of Canada's prime rate. It may have a lower initial rate, but the risk lies in future rate movement. Here's where it matters for investors. So prepayment penalties. Fixed rate penalties are often based on something called the interest rate differential, or IRD, which can cost thousands of dollars if you break early. And variable typically carries only a 3-month interest penalty, which is much more investor friendly. So refinancing flexibility. So if you're planning to do a BRRRR, flip, or pull equity within 1 to 3 years, variable rate gives you lower exit costs and greater agility. So strategic alignment. So choosing your rate type should align with your exit plan, expected holding period, and cash flow sensitivity, and not just rate headlines. So what is actually happening in 2025? So as of the recording of this video, we're in the middle of 2025. We've entered the early stages of a soft rate cutting cycle. The Bank of Canada has started trimming the overnight rate, and inflation has moderated but not vanished. And fixed rates have already reacted to the market sentiment and started to trend down. Variable rates haven't caught up yet. They tend to follow slowly as lenders price in risk. And here's something many people don't realize is that some fixed rate products today are actually priced lower than variable because banks are anticipating more cuts and pricing aggressively to stay competitive. So it's no longer a simple variable is cheaper equation. The smart play is asking which structure fits my timeline, goals, and risk profile best, not just which number is smaller. So investor specific factors. So here's what things you should look for when you're an investor before choosing fixed or variable. So what is your cash flow tolerance? If your margins are tight, fixed might give you peace of mind, but if your property has strong cash flow and you want the ability to break early, variable gives you flexibility, just know the risks. An exit or refi timeline. So if you're going to refinance in 12 to 24 months after a reno or value add play, you don't want to get hammered by a fixed rate penalty. In those cases, variable or 1 or 2 year fixed can be a smarter hedge. So consider lender policy differences. So not all products are created equal. Some fixed rates are fully closed, some variables have trigger rates, and some let you blend and extend like a hybrid mortgage. So it's not just about rate, it's about how the product works with your plan. So we also consider portfolio growth strategy. So if you're planning to buy again within the next year or two, keeping your debt load and monthly payments flexible might be more important than squeezing out a few basis points. Future leverage depends on today's structure. So what are savvy investors actually choosing? So many investors are going with short-term fixed rates, 1 to 3 years, to lock in stability without committing long-term. And others are doing BRRRRs or short flips and are leaning variable to keep penalty exposures low. And some are mixing strategies. Like for myself, I'm an investor, so I do fixed on long-term holds, variable on short-term plays, or I use lines of credits to fund renos while locking in stable financing on the exit. So there's no universal answer, only smart structuring based on your goals. So this video is all about educating you. This is not meant to be giving you advice, so always contact your local professional to get answers to your specific needs. But if you're sitting on the sidelines because of uncertainty, I get it, but strategy starts before the rush. Whether you're buying soon, refinancing, or just mapping out your next move, let's talk. Use the link below to book a free consult or just get pre-approved. No pressure, no push, just guidance that actually fits your portfolio. Thanks for watching Mortgages by Saul, where real estate investors in Ontario get clarity, not hype. And like the video, drop your questions in the comments and subscribe for weekly investor-focused mortgage strategies. And you can always reach us, text us in the links below. Thanks for watching, and we'll see you on the next one.